Hey everyone, welcome back to Corporate Decoder, where we uncover the juicy secrets hidden within those dry corporate documents. Today, we're rediving into some interesting moves by Hyperscale Data Incorporated. And let's just say there has been a lot of stock shuffling going on. We have a rather straightforward filing here, a Form 8K, which usually means something important happened that the company needs to tell everyone about right away. Think of it like a company's public announcement of a significant event. So, what is the big news? Well, the most interesting part of this filing seems to be about how the company has been issuing stock, which is essentially giving out new ownership pieces of the company. This is something that investors and people who follow the stock market always keep a close eye on, as it can signal growth or changes in how the company is financed. You see, companies have different types of stock, and they can issue new shares for a variety of reasons. In this case, Hyperscale Data Incorporated, or HYPERS, CALEDATA. INC, as it is formally known, has been very active in issuing shares of its class of common stock. It is like they've been printing new ownership certificates. Let us break down the numbers. Between late September and early October of 2025, the company issued a massive 8,750,000 shares of its class, a common stock. This happened because some people who held a different type of stock, Series B convertible preferred stock, decided to trade them in for this class of stock. It is like exchanging an old coupon for a new, different kind of voucher. They also did a similar exchange with their Class B common stock, giving out 256 shares of Class A common stock for an equal number of Class B shares. Then, things get even more interesting on the 7th of October. On that day alone, they issued a whopping 2226 455 shares of Class A common stock. This happened because someone converted a convertible note, which is essentially a loan that can be turned into stock, into shares. They converted nearly $906,000 worth of debt into ownership in the company. Now, here is a key detail that smart investors look for. The filing mentions that these shares were offered and sold using an exemption from the usual registration rules. This exemption under Section 4A2 of the Securities Act of 1933 is often used for private placements, meaning the shares weren't offered to the general public, but to a select group of investors. This is generally done for efficiency, but it also means that these investors might be sophisticated and possibly received a discount or special terms. So how much of the company are we talking about here? Well, as of the 9th of October 2025, the company had a whopping 188,945,811 shares of Class A common stock already out there. This recent flood of new shares is quite a significant addition to that already large number. It is like adding a whole new neighborhood of streets to an already sprawling city. Now, let's look at the bigger picture. What does this all mean? When a company issues a lot of new stock, especially through private placements, it can be for a few reasons. One is that they need cash to fund growth, like building new data centers or expanding their services. Another reason could be to pay off debt, which we saw with the convertible note conversion. Or it could be to reward existing shareholders or employees. However, issuing a large number of new shares can also dilute the value of existing shares. Imagine a pie. If you suddenly cut that pie into many more slices, each slice becomes smaller. So, for existing shareholders, their percentage of ownership in the company goes down, and the value of their individual shares could potentially decrease if the company's overall value doesn't increase proportionally to the new shares issued. This filing also tells us about the company as publicly traded stock. Their class of common stock trades under the ticker symbol GPUs on the nice American exchange. They also have a preferred stock, the 13.00% Series D cumulative redeemable perpetual preferred stock, which also trades under GPUs PD on the same exchange. This tells us the company is publicly traded and accessible to a wider range of investors. The fact that they are issuing a significant amount of stock suggests they are in a growth phase or managing their capital structure actively. Looking at this from a Warren Buffett perspective, we generally want to see companies that grow their earnings per share over time. When a company issues a lot of new shares, it adds to the denominator in that calculation. And if the earnings don't grow fast enough to offset it, earnings per share can actually go down. We need to see the accompanying financial statements to understand if the company's overall business is growing at a pace that justifies this stock issuance. Is this a strategic move to fuel future growth? Or is the company simply trying to shore up its finances? The fact that many of these shares were issued in unregistered sales, meaning they weren't offered to the general public through a traditional IPO or follow on offering, is worth noting. This often means those purchasing the shares are institutional investors or accredited investors who are expected to have a deeper understanding of the risks involved. This filing doesn't go into the gritty financial statements themselves, but it points to significant activity in the company's equity structure. It is a sign that Hyperscale Data Incorporated is making moves, whether it is to fund expansion, consolidate debt, or perhaps even prepare for future strategic initiatives. I'll be keeping an eye on their future filings to see how these new shares impact their financial health and long-term strategy. So here is my take on Hyperscale Data Incorporated based on this filing. The company is actively managing its capital by issuing a substantial number of new shares. This could be a strong indicator of aggressive growth plans, such as expanding their data center infrastructure or acquiring new assets. However, it also carries the inherent risk of diluting the value for existing shareholders if earnings don't keep pace. The reliance on exemptions for these sales suggests a focus on private capital rather than broad public offerings at this moment, which can be a strategic choice to avoid market volatility or secure specific investor types. A notable risk here is the interpretation of these stock issuances. Are they fueling sustainable, profitable growth, or are they a sign of financial strain? Without the full financial picture, it is hard to definitively say, but the sheer volume points to a company in motion. The opportunity lies in what this capital will be used for. If it is invested wisely in expanding their market reach or enhancing their services, the dilution could be a temporary and ultimately beneficial trade. In conclusion, Hyperscale Data Incorporated is demonstrating a proactive approach to its financial structure. The key question remains, will this increased share count translate into proportionally increased profits and value for all shareholders down the line? Alright, that is our breakdown of Hyperscale Data Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this stock issuance is a smart move for growth or a cause for concern? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching. See you next time.